Okie dokie. Let's just move the chat box out of the way. This is the currency strength indicator on multiple time frames. So I've got the 3-minute, the 5-minute, the 10-minute, and the 15-minute. And what this gives you is an instant visual on all the currencies, the major currencies individually, the building blocks of the market. And what we're seeing right now is we've gone through the London Open. You can see the timestamp down here. This is 8 o'clock UK time. So we're literally 13 minutes now into the London session. We automatically get the surge in markets. London markets open. I'm just looking over on another screen. FTSE 100's up. Had a big spike first thing. It's now gone into a congestion phase. You see that a lot. And basically what we're seeing right now is we've got very strong buying in the pound, the yellow line, pound buying, not reflected yet in the 15-minute, hasn't actually kicked up yet, but it's certainly got it on the faster time frames. In terms of other currencies, the one that I've been looking at following since we got up about 6:30 was the Canadian dollar, this purple line at the top here. It's been rising quite strongly, but it is now very, very heavily overbought. Up here, overbought on 10, overbought on 15. And then if you're looking for reversals, one of the questions we get asked a lot is well, you know, what is my tactic to market? Am I going to trade trends? Am I going to look for reversals? That's a personal decision. And the payoff is very simple in terms of the amount of risk you put on the table. If you're going to trade this Canadian dollar up here, for example, you're looking at it as a potential reversal, and probably against something like the yen, which is starting to kick up. And obviously that is going to be dependent very much on what is going on in terms of risk and risk assets. But if that's the pair you're going to look at in terms of a potential reversal, the payoff is that you will get into the trend once it begins to develop. There's no guarantee it's going to develop in the next 5 minutes or the next 10 minutes even, but at some point, the Canadian will start to sell and the yen will start to rise. And if you're in that position, then you're in the trend at the start, and the risk that you put on the table is much greater because your stop loss has to be that much wider. To allow for this buffering, for example, if you saw it getting up here, you've got to wait for this portion of time to pass before it actually starts to kick. It's starting to kick lower now. You can see it here, starting to begin to see it on 5. But this takes time. So you have to set a wider stop loss. Now, if you're trading something like a cross, where one currency has crossed below the other, which Anna was showing, I can't remember which pair it was, but on her annotation, pound Aussie. For example, you've got crosses going on here. You've got the euro selling, you've got the pound rising. So in terms of a euro pound, you've got the same here. It's pretty deep on the indicator. I'll come to that in a moment. But if you're looking at crosses, then that trend has already been established. The trend is underway. You're going to jump on that trend, and the cost of getting into the risk that you're going to put on the table in terms of entering that trend is going to be much lower because your stop loss is going to be much tighter. But then you're not going to take advantage of the trend that's already passed. You're jumping on something that's historically already been a trend for some period of time. You're just jumping into it. It's got some momentum. You put a tight stop loss on. You're going to grab it, go in, grab some pips, and get out again. Whereas with the reversal trade, it's much more what I would call a patience position, where you've got to wait and be patient. And in waiting, in that passing of time, you have to allow for the position to breathe, for the oscillation that is always following when you get these moves to one extreme or the other. This market, the currency market, the future, the forex market, is one of mean reversion. Currencies spend their entire lives moving from overbought to oversold and back again. It's just a question of which time frame you're in. That's all they do. They move from strong to weak and back again. It is a perfect market in that sense, if you like. So you're always picking off the pairs. You're looking for, am I going to trend trade? Am I going to reversal trade? And then you're looking at the CSI from the perspective of, well, which currencies are moving together? For example, here we've got the pound rising and we've got the New Zealand dollar rising, same here. So there isn't going to be much of a trend on that particular time frame for that particular pair, because when the two are traveling in the same direction, there's no differential driver. In other words, you haven't got strength in one and weakness in another, which is driving those two in opposite directions and therefore forming a strong trend. So you're always looking at things like that. And finally, in terms of CSI, you're always looking for currencies which are maybe flip-flopping around, are not moving particularly strongly in one direction or another, and are sort of moving in a flat way. And you can see it, the Aussie here at the moment, it's gone into a bit of a shell. It's flatlining here. It's not moving strongly. It's oscillating around in the middle here. So you're always looking for all these signals in terms of the currency strength indicator and the starting point. Let's just head on to the charts themselves. I've got the CAD yen up on, there we go. That's what we're seeing right now. Now, obviously, what we're also seeing in at the current time is, I've just popped this one open. They're all doing much the same sort of thing. This is Europe. So this is when 7 o'clock comes around our time. So this is the European Opens, when the European cash markets get underway. We start to see an increase in volume. This is all Far East Asia volume. Now we're into European volume. And now we're starting to see the London volume open up. And this is where we get these big spikes in volume. And obviously, we've got indecision here. We've got a doji candle. We've had the strong rally. This was the strong rally that saw that market drive up. Now, in terms of trading from breakaways, again, it's a question of a patience trade. And it's just a nice example. We were trading around the VPOC throughout the, this is all Far East Asia. We were trading around the volume point of control throughout our Far East Asia. We've got very strong levels defined for us. We've got support below with this little cluster here on the accumulation distribution indicator, which is based on price-based support and resistance. So we've got a cluster there, that's pretty strong. We've got a less strong one here. This has been tested and held 3 times. You get the little number comes up here on the indicator itself, but it's also defined by the thickness of the line. So the greater the number of tests or retests, then the thicker the line, and therefore the stronger that area of resistance. So this was pretty much holding as a strong area throughout. Then we had the European Open. The market rallies strongly. We get nice volume under here. Yes, we got a volatility trigger. It didn't follow through into congestion on that occasion. It drove through into the next candle with this volume. Then we start to get some weakness signaled. This candle here has got a wick to the upper body. We've got decent volume under that candle. So there is indecision coming in. We then get, sorry, apologies, that candle is this volume, sorry. Then we get further weakness. We've got a wick to the upper body, we've got decent volume again, but we actually got higher volume than these two. But the actual candle's got a wick to the upper body. We know we're coming into the London Open. So we've always got half an eye on when the session crossovers are coming, because those are the periods at which you're either going to see congestion, volatility, or reversals, or potentially all three. And it doesn't really matter which pair you're looking at. When you come into it, clearly that is going to be reflected pretty strongly in terms of local currencies, particularly obviously the pound and the euro for us in the UK, but you are going to see it reflected in all markets. You even see it in Globex on US markets. You might think, well, you know, that why does that occur? It's just a fact of life. As Anna said, this is all about related markets. Related markets are all about risk. It's about risk and return, nothing else. If you think about it logically, that's all the money markets are about. It's about chasing higher risk for higher return or lower risk for lower return. It goes back to what I said about setting your stop loss in terms of risk and return, whether you're a reversal trader or whether you're a trend trader. It's exactly the same principles apply. Whatever you do in trading, the more risk you're prepared to put out there, then the greater should be your reward. Less risk, the smaller the reward. It's very, very simple in that context.
Would you just answer Martin?
I can. Sorry, apologies. I always have the chat box closed when I'm in full flow. Would you generally enter with a pending order as opposed to market order? Good question. Sorry, darling. Previous question. Apologies. Sorry, just scroll up a bit. Once you've identified your potential trade and waiting for entry, what gives you the actual go signal? Do you wait for a pullback or right? Once you've identified your potential trade, what gives you the actual go signal? Well, many things. It's you're not just looking at one chart, you're looking at multiple charts. There isn't really anything that I could say to you is this is a go signal, this is an automated signal. It doesn't really exist. In our world, we are discretionary traders, and by virtue of being a discretionary trader, what that means in simple terms is that you make the decision as to what you see on the chart. You assemble all that information, you look at the chart, and you make a decision accordingly. There will be occasions when you will see a signal and it just springs off the page at you and you go, yeah, that's it, I'm in. And you don't really give it a great deal of thought. Others, you will assess in more detail. You'll look at the chart, you'll look at multiple time frames, you'll look at levels of resistance, levels of support. And it goes back to what I always refer to is when you're looking at positioning your stop losses and the opportunity. In fact, let me look at this. Let's look at this one as an example. Okay, supposing you're looking at this as a reversal opportunity. Let's say, you know, you've looked at the CSI, you've thought, yeah, I like reversal trading, which is what I do a lot. What are you going to look at in terms of the chart, in terms of the setup, in terms of what you're considering as your potential entry point? And there is no hard and fast rule I can give you. All I can say is that having looked at the CSI, for example, we would go and look at the array, we would look at the matrix, go there in a minute. What's happening in terms of universal sentiment? If you're looking at the CAD yen, for example, you're going to have a quick look at oil. You know, what's oil doing? Is that going to help me? Is that going to hinder me? You look at sentiment, because we're in a sentiment pair here. We're on a CAD yen, so you want to know what the yen's doing. So you want to know what's happening in terms of sentiment. And in terms of, I'm just looking over another screen, I'll pull it over in a minute, but in terms of volatility, you know, the VIX is down a little bit. So what that is telling you is that if the VIX is down, then, you know, sentiment, you're looking at a possible yen scenario where the yen is going to be sold because, you know, it's risk on sentiment, it's not risk off. So you've got to factor that in as well. Then you're looking at the volume profiles here. You've also got to remember that in terms of the London Open here, you know, we can't really compare this volume over here because this is European, this is London. So we've got to be a little bit cognizant of the fact that we can only compare light with light, apples with apples, not apples with pears. In terms of the weakness here, this is a nice signal. We've got an effort to rally, big wick to the upper body, decent volume under there for the London Open, although it's not huge. You know, is that enough of a trigger to get you into the position? And what it comes back to is how long are you going to hold this position? Well, if you're looking at it in terms of the CSI, let's just go back onto the CSIs. There we go. And this is what I meant. You know, we're flip-flopping around here. Yeah, we had a little curl over here, but it's kicked back up again. You know, it hasn't got that strength yet of development. Yes, we are seeing some yen buying here coming into the market. We've got some yen buying here and yen buying here as well. But in terms of what's happening in terms of the CAD yen, until the CAD actually starts to move, we ain't going to see much in terms of the trend development. So it's a question of, do we want to be patient? Because ultimately what may happen is that the yen may actually rise all the way up to the top. It's perfectly feasible. We then have the CAD yen at the top of the chart, in which case it means that there's been no trend on that particular trade. There's no perfect scenario where it says that this is going to travel all the way to the bottom and this is going to travel all the way to the top. It's a question of putting all the pieces of the jigsaw puzzle together and making your decision accordingly. So I can't give you a very simple answer to that one, Martin, I'm sorry. It's just you have to make a decision according to everything you see on the chart. It depends on your time frames. It depends on how much risk you're putting on the table. It depends whether you're trading reversal, which you're going to have to be more patient, or whether you're jumping into an existing trend. If you're jumping into an existing trend, for example, just pop that out of the way. I don't even need to look at a chart right now. Certainly in terms of the slightly slower time frames, you've got the euro falling here and you've got the dollar rising. So we know we've got strong dollar buying. Let's just go on to the currency indices for a moment, wherever they are. Currency indices, won't find them. Oh, where are they? There we are, in the middle. Okay, there we are. This is the euro down here. We've seen some decent selling with it. This is on 15-minute now. So we know we've got strong dollar buying. We can see it here. This is the dollar index on 5-minute. This is the CSI on 15-minute. So we know we've got strong dollar buying at the moment. We've got decent euro selling. So in terms of looking at that particular pair, you wouldn't be looking at, for example, the dollar CAD right now, because they're both rising pretty strongly for the time being. So it's just a question of teasing all this information apart. I mean, if I pull over here we are. Let's just pull over this. I just want to show you something else on here as well.
Well, before you do that,
Oh yeah.
just say something.
Yeah.
Don't change the sort of screen. Sorry.
Okay.
Just say something.
I'm just going to switch off. Anna wants to jump in, but I'll change back onto the CAD again itself.
One of the things you have to do is, particularly when you start, is decide what is your favorite setups as a trader. And you will, that there are some setups on charts, some combination of factors that will suit you better as a trader. Now, there's two ways to approach this. You either do that, you focus on, as David said, do you want to be a reversal trader? And for a reversal trade, you're looking at extensions, and you will be looking at a chart pattern that is very different to a pattern that is in a range bound in a consolidation phase. So your signal for a reversal trade, either from bearish to bullish or bullish to bearish, is your candle patterns. What kind of volume are you going to be looking at for that that qualifies for that particular setup? So that's a sort of a reversal. If the trend is then underway, in the reversal has already happened, and we have a trend that's moving. You asked about a pullback, and you want to join a particular move. Well, what you're looking at, let's talk about primary and secondary. If the primary trend is moving lower and the volume has been rising, and then you have a pullback, it corrects, if you like, and it's going higher. If you have rising volume in that secondary trend, the chances are that it's going to reverse. What you're looking for in a downtrend, you're looking for a downtrend with rising volume. You will get a reversal, you will get a correction. In that secondary correction, that secondary pullback, you don't want to see rising volume. You actually want to see falling volume, because that will confirm to you that the primary trend is likely to continue. Pretty much like we saw on the daily chart of my Euro Aussie, where it had pulled away from the volume point of control. Then we had the ECB on Thursday. We had a fairly big up candle with a reasonable amount of volume. Then we had Friday's candle, which I think was even bigger, but the volume was falling. So that, if you like, that pullback, that is not telling you that it is going to go any further, because A, the volume is falling, but secondly, it also went slam back into the volume point of control. So that's where you bring your support and resistance level. But to get back to your question, and this is, think about it in setups. When you open your chart of a pair or your preferred pair, the chart will be it will have what we call a C state. It will either be in a trend, it will be in a consolidation. It will, the chart will talk to you. It will have its own narrative. You then have to decide is, well, actually, it's not really displaying it's not in the state that I like to trade. Because you have made a decision that your tactics, you like a reversal, you like to see the setups in the chart in a particular way. Now, to arrive at that point, that decision point of what you like to trade, how you like to trade the chart, first of all, you've got to understand what the chart is actually doing, which is what VPA will tell you, and what our program will tell you, is then you're presented with a chart and the narrative that's on a chart. You then have to decide, is the setup on that chart a setup that I like to trade, or no, it's not, in which case you maybe look at something else, or you wait. Or you say, no, I understand the chart. The chart at the moment is in a trend, so it's obviously going to be some kind of trend trading. No, the chart is in a consolidation. There's going to be some sort of breakaway trading. So that's how you approach it. And can you have more than one setup? Yes, of course you can. but you won't know what you like until you try it. So there's going to be a little bit of trial, a lot of trial and error at the beginning. Possibly use the faster time frames, because obviously things move a lot more quickly, and get to look at everything in the context of multiple time frames. And volume will always confirm, you know, whether that setup is going to play out as you think it's going to do. Is that okay, David? Does that it?
Yeah.
Does that make sense, right?
Thanks, darling. And really just to pick up on that point, and to answer Martin's question again, is when we're looking at this particular trade, there are several facets of this that I wouldn't take it at the moment as a reversal trade, because it's not, there are too many factors which are working against me. For example, if I pull over I've got trading view here. I want to show you something else on here in a moment, but we'll do that later. We look at the volatility index up here, the VIX. What's happening with the VIX? Well, the VIX is falling. So what does that mean? Well, it's yen selling. So if I'm short and I'm looking for yen buying, then that's going to be working against me. So I'm really not too keen on shorting yen pairs right now, because the sentiment in the market is risk on. And that's reflected in terms of the volatility index here this is on 1 minute, so this is pretty fast. This is the UK 100, the FTSE 100 index, which is rising quite nicely. And that would also be reflected, just move that out of the way. That would also be reflected in terms of US markets. Let's go and have a look at US indices on Globex, which is down here. There we are. So if I'm short a yen pair right now, I am fighting the market, because what the market is doing, and you can see it pretty clearly here, this is the three sisters, as we call them, the three US primary markets. We've got the YM, this is the Dow, this is the NASDAQ, and this is the S&P 500. These are the mini futures, E-mini futures. And what you see here is strength in the market. So it's risk on. So these indices are rising strongly. We've got nice volume coming in under these candles. So the quid pro quo is you expect to see yen selling, because the market is in risk on sentiment. Now, in addition to that, you've also then got the factor of oil. So what is going on in terms of the oil market? Let's go and have a look at the oil market. Okay, well, that's pretty bullish as well. We've had a little, this is on 3 minute, 4 minute, 10 minute, 15 minute, 30 minute, and over onto the daily here. So what have we got intraday? Well, we've got some decent buying of oil. The oil price is pretty strong right now. Forget about all the politics and all the rest of it, and the the ongoing in OPEC and everything else that's seen oil collapse and is now starting to rally. But from an intraday perspective, from a currency trading perspective, I've got so many factors now working against me. To sell that particular pair right now is just madness, because you're trading against everything in the market is going in the other direction in terms of risk. So it's a massive, it's a huge high risk proposition that I just wouldn't be interested in right now because of all these factors. And it's just a very, very clean example of why it is that forex traders struggle to succeed in this business, because they don't understand all the relational aspects of market behavior and what this business is really about, which is just about risk on, risk off, money flow. It's levels and flow, and you then bring in all your other levels of indicators to help you in that decision making. We've got the trend monitor here, which is a fantastic indicator. It just helps to keep you in to maximize your profit from any trend. It doesn't, it takes a longer term view of the trend, and when you're using it in multiple time frames like this, the 3 minute, the 4 minute, up to the 10 minute, what is this telling you? Just flick that on again, just reload the VPOP there. We're breaking away from the volume point of control here. I know we're staying with oil for a minute, but there we go. We're breaking away from the volume point of control. We've had a little bit of selling come in there. We've actually continued high with decent volume under this one. No particular wicks to the upper body. We've gone through this low volume node, which is what we expect to see. When you're looking at the volume point of control, you're constantly looking for those low volume areas and the high volume. Where you see low volume ahead of you, then that's an opportunity for the market to move through pretty swiftly. For example, here, we can see the attenuation, the decline in volume on the volume point of control, which is good. If we're long in oil, if we're buying oil right now, we're coming up to low volume areas here, so we should see that move through pretty swiftly. It's nice to see. Same on 15. Let's pop that one up there. There we go, same sort of thing. So let's just pop that out of the way. So going back to our CAD yen again. There we are. And we're starting to see a little bit of selling coming in now. But in terms of going back to what the proposition I posed at the start, really, which is looking at the currency strength in multiple time frames, this is why you have to be patient as a reversal trader. Reversal trading is not for everybody. You can see here, it's still rising, the currency, the CAD. Look at the amount of time we've been sat here now. There is some bullish momentum still, but it's flip-flopping around. It's a question of being patient, and that's what this business comes down to. I pulled up the currency array while Anna was talking and just isolated out on the CAD. You can see there pretty much universal what's going on in terms of the CAD across the time frames, the 3 minute, 10 minute. Sorry, let's change that up to 15. Put that on 5. There we are, just put that up onto 15. Wait for that to load. We'll just isolate out the CAD there. There we go. And of course, what you also see in terms of the currency array on this column here is it also gives you a heads up in the same way as on the currency strength indicator, where you see those regions of overbought and oversold. Now, when these lines go solid, that's giving you a signal that the Euro CAD on 10 minute, for example, is now at a potential oversold situation. So you would go and look at the chart, say, okay, well, let me have a look at the Euro CAD. Is it something I want to trade? What are the relational aspects of that particular trade? What's the volume telling me across the time frames? What is my chart telling me in terms of potential opportunity? Have I got a lot of support and resistance that's going to come into play? Am I at the VPOC? Have I got stuff above and below that is going to cause that position to give me problems? How much headroom have I got on the trade? Is it worth taking? And you judge your risk and you get in accordingly. In terms of going back to the question mark, in terms of whether you put a market order in or a limit order in, again, it's something we cover in detail in the program, but that's, again, it's a personal thing. I have to say, from a personal perspective, I tend to use market orders a lot more than I do limit orders. But if you're at work or you're not in front of a screen all day long, then you generally do have to use them. If you're congestion trading, for example, if you're breakaway trading, then you have a channel of price and you set your orders above and below, they will be triggered. And it's just a different style of trading. There is no right and wrong answer. There's no right and wrong way to trade. It's what you find works for you, what you're comfortable with. It's partly dependent on whether you're in front of a screen all day long or not. I know a lot of traders don't use market orders. You just find what works for you. For me personally, I think also for Anna, once you've made a decision, that's it. You want to get in the market, and that's it. Get in, get on with it. But other traders like to take a more distance view in terms of putting orders in the market, and there are advantages and disadvantages in both. If you predominantly trade market orders, you're always at the mercy of making a snap decision on gut instinct, reaction, whatever it may be. Whereas when you place market orders, when you place limit orders, you tend to take a more considered view of the chart. So, that is a good thing. You'll analyze a little bit more detail. You'll take a little bit more time over it. You'll look at the various levels. You think, right, okay, well, I think that's a good level, or perhaps there, and that's a good place for my stop loss. It's a much more, I would say, considered, I suppose is the right word. It's a more considered view of what you're about to do. Whereas when you're placing market orders, you tend to just make a snap. You look at the chart, you do your analysis, bang, that's it. I mean, let's get in, let's get on with it. Again, that is partly driven by your personality, but it also has a lot of other factors in there. But there are pros and cons of both approaches. Nothing is right or wrong in trading. It's just what you find works for you best.